Good morning, everybody. This is Hari Swaminathan. I'm looking at Google chart and something jumped out at me. If you can see the Google here, look at this one. This was on last Friday. This was last Friday. Yep. Suddenly there's a huge spike in volume. So volume really tells you things when something jumps out of the ordinary. You can see for the past, I don't know how many, for a few weeks at least, the average volume is around the 2 million shares, whereas suddenly on Friday it spiked to 4 million, it doubled. So what was the reason? And was it buying or was it selling? So if you look at the bar itself, it doesn't tell you much. The bar was an up bar ultimately, but it was very short. So obviously this is a lot of selling because the next day there was no follow through. In fact, the next day it just tumbled. So which tells you a lot of this volume was selling volume. So obviously, which means, in the short run at least, Google has some resistance right here. It has some resistance right here, and of course, it has a pretty big high resistance right here. So basically, what that says is, Google, its upside is somewhat limited. It might, come up and everything. So what we want to try to do for Google then is you look at now we are entering into earnings season, so we have to watch out for that. And in fact, Google announces on 10/17. So which means my guess is that would be this series, the October series. Yep, you can see the volatility has jumped up to 27 already. So basically, we don't want to go there. We want to go one level before that. So because we don't want to get impacted by the earnings. And basically, it's a bear call. 15 days left. Let's say we go to the 120 level and if we have to sell a bear call at 920, 925, that's 32 cents. And 32 cents would be approximately about 7 to 8%. But bear in mind, this has only 15 days. So, basically, if you want to calculate on a monthly basis, this would actually be 14%. But on this trade, we have a 32 cents. Now, if you wanted to come a little closer, you could at 915. But, I think given that I think what we want to do is to stay safe, and that way your adjustments are lesser, and most of the time, at least a big percentage of the time, we can just let it expire. So that's a better strategy because many people may not have the time to look at these positions. Although I prefer somewhat closer strikes, but I know many people may not. So I think here we are looking at a decent 920 is an approximate delta of 10. Okay, so it has a 10% chance, an approximate 10% chance. So I think that's very good. If you wanted to come to a 12 delta, that's perfectly fine. To 915, I think 12 delta is also perfectly acceptable, given that it's at 877. So let's say 915, 920. That's, a very, very respectable credit there. That's 9% return in 15 days. All right, so this is a trade that we want to put in. And given that there is uncertainty in the market because of the Washington budget battle, I think a bearish trade makes sense. However, we'll have to keep in mind that if there is some kind of resolution in Congress, then all stocks, including the overall market, will go up, and perhaps we may have to adjust it. So it's up to you. If you want to be a little safer, go to the 920. I'm going to put it at the 915. It's a 12 delta. That's safe enough. However, given all that stuff that's going on, maybe you want to go to the 920, 925. All right. Thanks. Bye bye.